Student loan payments are restarting this October. And now you have some economists saying that when student loan payments restart, that is going to trigger a recession. David Rosenberg is the famous economist who became well known because he called the housing market crash. He predicted that the dot-com bubble was going to happen before it happened. And now what he's saying is that the United States could be entering a recession, not because of the housing market, not because of inflation, but because of student loan payments restarting. Here's what he has to say. He says, quote, "I think the recession is going to start at the consumer level, and I think that we'll see the first signs of this recession after the student loan forgiveness program ends in the coming months. So I think that it's going to be consumer-led." Now, just a little bit of a disclaimer. David Rosenberg has been known to be a bear on the United States economy and the markets, meaning he's believed that our economy is going down. So take everything you say with a grain of salt, but my goal is not to tell you what to believe, rather help you be financially educated. That way you can make smarter decisions with your money, because over the last week, I talked about how the government and the Federal Reserve Bank no longer believe that there is a recession coming. Now you have some economists who believe that a recession is on the way. Now, I want you to understand both arguments. That way you can make a smart decision for yourself, because obviously I have my own opinions, but I don't want you to blindly follow a random guy on YouTube. So with that, let's jump into what's going on here. And by the way, tomorrow is my investor summit here in Manhattan. I'm doing it live. If you have not signed up yet, it's completely free. I'm going to be talking about how our economy has changed, how money has changed, and how you can capitalize on investment opportunities in this economy. This investor summit is completely free. So if you have not joined it, make sure you register, because there's a limited number of seats. And I got the link for you down in the description below. Now, jumping into things, what David Rosenberg said is that the full impact, part one, of the Federal Reserve Bank's rate hikes over the last year, so in 2022, have not been fully felt yet. What he says that historically, when you raise interest rates by 5%, which is what we have seen happen over the last less than 18 months, it generally takes 6 months for a recession to kick in. Now, we've seen the Federal Reserve Bank raise interest rates from the lowest levels ever in the early part of 2022 to now over 5%. And this is where he's saying that historically it takes about 6 months to see the economic slowdown happen, because it takes time for the impacts of higher interest rates to be felt. Now, what he didn't talk about was the speed at which the Federal Reserve Bank raises interest rates, because right now we have raised interest rates so fast that our economy hasn't fully felt the impacts of the higher interest rates yet. That's why the Federal Reserve Bank keeps saying that when they go to raise interest rates, one of the things that they're paying attention to is the lag effect of their higher interest rates. Meaning, we've raised interest rates so much in the past 6, 9, 12, 18 months that before we go out and raise interest rates more, what we want to kind of predict is what is the lag effect of the previous interest rate hikes that we did. And this is where David Rosenberg is saying that generally when you raise interest rates by 5%, that causes a recession. But because the interest rates were risen so quickly, that it could potentially take longer, just because it takes time for the interest rates to be felt. And we raise interest rates so fast that it's kind of a shock to our economy, but it also takes time because debts have to readjust as well. And then he goes on to say this: "I think that by the third or fourth quarter of this year, 2023, we're going to start to see more evidence of a recession, but it's going to come out of the consumer side, not the corporate side." And the reason why this is so important to understand is because the consumer is already struggling. Now, our economy runs on spending. The more money you spend, the more money somebody else makes. I've talked about this before. When you go to Chipotle and you spend money, Chipotle makes more money. When you go to Sweet Green and you spend more money, Sweet Green makes more money. When you go to Lululemon and you spend your money, they make more money. But if you're not spending your money there, these companies are not making money. And if companies are not making money, they can't grow. And in fact, sometimes they have to downsize. And what we're seeing happen right now is the inflation is really starting to catch up with people. Over the last week, I talked about how more and more Americans are digging into the 401ks. Bank of America put out a study which said that over the last 12 months, hardship withdrawals out of people's 401ks are up 36%. In addition to that, we've seen credit card debt in the last week hit a brand new record high of $1 trillion. In addition to that, I don't report on this week, but maybe in the last month or so, we talked about how savings rates in the United States are kind of coming down because, well, people are digging more and more into their savings. So what does this mean? People have a certain lifestyle right here. Costs have gone up to here. And now people live in a lifestyle here have to say, okay, the costs are higher than what I'm making. Now, do I go into debt and dig into my savings to keep funding my lifestyle, or do I cut back on my lifestyle? And what we're seeing a lot of people do is, I'm not going to cut back on my lifestyle, let me keep spending. But there's a limit to that. There's a limit to how much debt people can take on. There's a limit to how much you can dig into your savings. And this is where what David Rosenberg is saying, well, student loans are restarting in just a few months. And when student loans restart, that's going to be a burden on people on top of everything else going on. Now, I know that the presidential administration has created like a 12-month, I don't want to call it a grace period, but a 12-month period where a lot of media companies are advertising you don't have to necessarily start making your student loan payments right away. But I want to caution you here, because that is a very dangerous thing to say, because this 12-month, and I don't want to call it a grace period, I don't know what to call it, this 12-month period when student loans start, the government has said that essentially if you cannot make your payments, that's okay. However, your interest will still be accruing. So if you're not making your payments during the first 12 months, it is going to come with a penalty. Which is why, although a lot of people are saying that you have some runway to start making the student loan payments, you do not want to treat it like runway, because it's going to cost you more if you do not start making your student loan payments in October. Which brings me to the point of, what does this mean for you? Because the reality here, and this is tough for a lot of people to understand, but I'm going to be very honest here. If you have student loans, start preparing today. It is August right now. You have 2 months before October, September and October and August, to start preparing for your student loans. That means put money aside today, right now, today. If you have federal student loans, it's 0% interest, which means pretend like your student loans are starting tomorrow. Put that money aside, put it into a high interest savings account, whatever, and let that money grow a little bit, and pretend like your payments have already started, and start making those payments, because now once October hits, your payments are going to start. So start practicing living below your means and start putting that money aside. And then once October hits, attack your student loans. Pay them down. Pay them down quickly. That way you can get out of your student loans. And that means preparing right now, because, well, you're not paying any interest. So if you can pay down your balance without any interest on top of that, that means less interest that you're going to have to pay in the long term, which means you have to start preparing now. I cannot emphasize this enough. I posted about this on Instagram, interestingly. And a lot of people were very upset by this idea of starting to prepare for student loans, with people saying, oh, I'm never going to pay my student loans back. This was like a common trend, I guess, on the internet, that people are now coming up with these ideas to never pay their student loans back, even though the payments are going to be coming due. Listen, you cannot bankrupt your way out of student loans the way you can other consumer debts. Why? Because it's the government's debt. And interestingly, if you go to Google and you search the United States government, #1 asset on their balance sheet is student loans. Yes, it is very profitable for the government to keep Americans in debt, particularly student loan debt. It's the #1 asset on their balance sheet, which is why now it is so important for you to be financially smart, because if that's the case, now you have to take care of your own finances and take care of your own financial education, because no one's going to come and tell you these things. You got to go out of your way to learn this, which is why I'm telling you, if you want to avoid the financial pain, start preparing today. Don't be shocked when the student loan payments restart, because they are restarting, and build that cushion today, because if you can pay down a big chunk of your student loans the day that they start, your balance will drop, which means you have less money you're going to have to pay interest on. So understand that your student loan payments are restarting. Understand that inflation is still around. Understand that the Federal Reserve Bank is still working to potentially raise interest rates even higher. And also understand that we haven't felt the impacts of the higher interest rates yet. And as student loan payments restart, as people start to feel the impacts of higher interest rates, that's when we'll see more impacts of all these things happening in the economy. And I want to add one last thing to this, which we didn't hear from David Rosenberg in this interview, but corporate debt and commercial real estate debt. We have a big chunk of it readjusting in the next 24 months, 2 years. And this is why I keep saying that 2023 is not the year for you to go out and finance a new truck, because in the next 24 months, we have just under $2 trillion. $2 trillion of corporate debt readjusting, and right around $1 trillion worth of commercial real estate debt readjusting in the next 24 months. The reason why this is so significant is because this debt is going to be readjusting at a much higher interest rate, assuming the Fed does not cut interest rates. And if that happens, you're going to see the expenses for a lot of corporations and landlords rise. And if the economy is starting to slow, because maybe consumer spending is slowing, well, you can start to see why that might be an issue. Which is why, again, don't use 2023 as the year to go out and buy a whole bunch of fancy stuff, because you can use 2023 as the year to get financially smart and to get prepared. Because as things continue to progress with the higher interest rates, the higher expenses, with still high inflation, well, there's going to be an impact to all of this. I understand being patient is not fun, but patience is where the real wealth is built. And that's one of the things I'm going to be talking about in my Investor Summit tomorrow, which is why if you haven't joined me yet or registered, make sure you do so. And with that, I'll see you tomorrow.